Hey everybody, it's David. Well, we made it. It is the end of the third quarter. It's time to do that financial review, and that's what I'm going to do in this video. As promised, every quarter I am going to share how my investments are doing for the year. I did a video back in January, a very extensive one explaining all of my investments. I'll put that down in the description. I also did one, back in July, doing that second quarter. Well, now it's third quarter time. How am I doing? How is my portfolio doing? Well, hey, let's talk about it. All right, well, first of all, big disclaimer. This is not investment advice. I am not saying you should do anything that I am doing. For the sake of transparency, I just want to share, how I'm doing and what I am invested in. Do not take this at all as investment advice. And welcome to David in Progress, where we talk about three things. We talk about achieving financial independence, retiring early, and doing your best to live your best life now, all from the perspective of just a regular guy. Hey, if you want to support my channel, the number one thing you can do is just give me a thumbs up, leave a comment. But first of all, I'd love to hear how you're doing so far this year. The thumbs up and the comments, those really help the interaction and tell the algorithm that you're getting some value from my content. Thank you so much. All right, well, I'm going to cut right to the chase and tell you how I am doing year to date. Year to date, my retirement investments have a return of 10.46%. I am so very happy with that. So we're going to talk a little more and tell you how I got that 10.46%. And it's good for you to know my investment strategy or philosophy now that I am early retirement. If you're new to this channel, I retired early at 56. I was laid off. Last year was a little different. I had a severance. This year is really my first year that I consider myself truly early retired, in that I'm living 100% pretty much off our retirement investments. So here is my early retirement investing strategy. I'm no longer chasing returns. The focus of my portfolio is more and more towards preservation. No individual stocks. I haven't actually owned any individual stocks in a very long time. All that I have that you'll see here in a little bit is low cost index funds. That's all that I'm doing, and I want to keep things simple, which is that final thing. Simple, simple, simple is really what I'm trying to do. I don't like things that are complicated. I want to be able to understand everything that I'm doing, and that is one of the reasons I have very limited number of funds and why I'm trying so hard to keep things simple. I did make one change after the second quarter. I know I said if you watched that other video I wasn't going to make any changes, but after doing some more thought and thinking back to my investment philosophy, I decided to add even some more diversification, and I added an international fund, which I will cover and tell you how I am doing with that fund. The next thing that I think is important to discuss, because I did get some questions in the comments from our previous video, is our withdrawal strategy. One of the things that I'm doing is I only withdraw twice a year. So in July, I did that second withdrawal for the year. January was the first. And I got the question about why do I do that? Well, remember talking about simplicity? That is one of the things that I, again, am trying to do. And for me, it's just more simple to only do the withdrawals twice a year. And I'm kind of splitting it up. In January, I only withdrew from our taxable brokerage account, sold some of those mutual funds, which is fantastic because I will pay zero tax on those, something I could explain in another video. And then mid-year in July, I did the withdrawal to pay for that second half of the year. And it just keeps it simple, just two transactions. When I withdraw, that money goes into my high yield savings account, and then monthly, I just go in and pull out of it. It's kind of nice to see that balance going down because it holds us accountable to our budget. Now there's an end point where that little bucket's going to be empty. So we have to be careful to manage our budget throughout the year so that we are sure to still have some money left over at the end. It all goes back to being simple. All right, let's get into it. As I did back in January and as I did back in July, I'm going to go through every one of the funds that I'm invested in. These funds are exactly the same as far as across all of our accounts. Not only do I have my 401k sitting out there that I'm using the rule of 55 to withdraw from, my wife has a legacy IRA account from when she was working. I have an HSA account and I have a separate Roth account. But even though I have multiple accounts, they are all in the same fund. So it becomes just one big picture for me. I've got all this printed out. I'm going to bring up a screenshot of what I'm speaking to so that you can just follow along. I will also in the description have chapters to make it much easier to find these things if you want to skip around a little bit just to see the various funds. Okay, let's get it in this first one. It is the Fidelity 500 Index Fund FXAIX. This is my core fund, and you can see it is doing great this year. Year to date, it is up 14.82%. And when you're looking at a fund, you not only want to look at the year to date, you want to look at how it has done 1 year and then years in the past. So here, let's look at this one. This year to date, as I said, is 14.82%. If we go on across, you can see the 1 year return is fantastic at 17.59%. 3 years at 24.92%. 5 years at 16.45%, and that 10 years at 15.29%. An index fund like I have here, the main thing besides the growth is also the cost. If you've read J.O. Collins' A Simple Path to Wealth, I certainly hope you've read it. You probably have learned about cost. And you can see that this fund is very low cost at 0.15%. So 14.82% for my core account. This represents 52% of my retirement savings. Hey, I was pretty happy with that return. Next year, we have the Fidelity Blue Chip Growth Fund. I went back and reviewed my video from earlier in the year, and I talked about wanting to draw down on this one. If you'll remember back in April, there was a big crash. Well, this particular fund is my most unstable as far as big swings down. Well, it also has big swings up, and it also has my highest expense. The year-to-date return on this one was 15.85%, which is fantastic. You can look across there and see the 1 year at 26.41%, 3 years at 35.38%, and so forth. 10 years at 19.97%. In reality, this is a small part of my overall portfolio at just 5%. And I'm having a hard time letting go of it. It's a Fidelity fund pick. You can see, though, that expense at 0.61 is my highest, but the return is higher too. So I think I'm balancing out. I don't know. What do you think on this one? Next, we have the Fidelity Zero Extended Market Index Fund, which basically is a small cap fund. It's something new that I added this year. I've been watching some interviews with Paul Merriman, and I've been thinking a little bit more of a risk parity portfolio. So this is something I added as a bit of experiment. You can see that is turning out okay. The year-to-date return is 10.14%. Look across there, the performance. 1 year at 11.18, 3 years at 16.46, and the life at 8.31%. The cool thing about this one, this is one of Fidelity's zero expense accounts, and that means you can see it down here, the expense ratio on this one is 0. So even though the return on it is slightly less than maybe some other funds, I think that 0 expense ratio helps make up a little bit, and plus it is that exposure directly to those small cap funds. Now here we are with my new fund. I added this in July after filming that previous video. I had about $1,000 in an international fund just to see how it would do. And I'll tell you, it was doing great. So I decided to up the amount that I have in it, and I may be adding more in the future. So let's look at it. This is the Fidelity Zero International Index Fund. This is another one of those Fidelity funds, as you'll see down below, with 0 cost. There is no expense ratio for this fund, 0 cost. And look at that year-to-date return at 27.36%. That is fantastic. Now, for many, many years, I did not have international because for many, many years, international was doing so poorly. But things seem to have turned around in the international market. And with all the questions here in the United States with our market, it made sense to do some diversification to have something that it was exclusive international. So 27.36% annual, 1 year at 17.95, 3 years at 21.62, and the life, you can see that life indicates how it was doing in the past at 7.62. Now, I did not earn 27.63%. That is the 1 year return. I didn't put money into it really until July. So my returns is less than that. And this represents 4.5% of my total portfolio. So question back to you, what are you thinking about international? Do you think it should be added to the portfolio? Was this a good idea or not? Give me some feedback on this one. And that's it. Those are all of my equity accounts. Those are all the funds that I have invested in the stock market. So from there, next, we're going to look at my bond funds. The same with the equity accounts here when you get in the bond funds. Again, I'm sticking to just index funds and I'm sticking to very low cost. I'm not buying individual bonds, that type of thing. I'm basically just a mutual fund guy. So here we are with my core bond index fund. It is FXNAX, and this is 18.5% of my total portfolio. And you can see the year-to-date returns of it are actually doing really well compared to the past at 6.05%. If you look across, the 1 year is 2.75, so that indicates to you, yeah, it has made a big comeback in this last couple of months. 3 years at 4.8%, and then 10 years there at 1.80. Bonds and these things, they bring down your returns. Remember there at the very beginning, I'm talking about no longer chasing returns. The purpose of bonds is not to have returns, not to have growth. It is protection. It is, as J.O. Collins called it, they are the account to smooth the ride. So in theory, the next time the stock market crashed, which absolutely it will at some point, these bond funds help protect my wealth. They will not be impacted, in theory, as much as the market fund accounts. This bond fund is Fidelity Short-Term Bond Index Fund, FNSOX, and you can see the returns are a little bit less than my core fund. I also have less of our savings in that at 3.3%. So the year-to-date return on this one is 4.82%. You can look across the 1 year at 4.07, 3 years at 4.92, and on. This is another one of those very low expense ratio funds. If you look down below, the expense ratio is 0.3%. So very, very inexpensive to have this account. The last one I have is also a bond fund, the Vanguard Institutional Total Bond Market Index Trust. That's a bit of a mouthful, but basically this is a proprietary fund that's within my 401k. It's not something you can buy on the open market. In this fund, I'm basically using just to park my money. This is where I take the money out whenever I'm doing those Rule of 55 withdrawals. And you can see the return on this was actually pretty good as well at 6.21%. I was pretty happy with that. And the last one I have is the Fidelity Government Cash Reserves, which is exactly what it sounds like. It's just where I am parking some cash to keep it safe. So this is always going to have that lower than everything else return. And the year-to-date return on it, look at it, is 3.05%. You can see the 1 year at 4.19% and so forth. This is always going to have a very low return. It's that this set and forget it kind of account. And this represents 6.75% of my total portfolio. Well, that's it. That's the entire retirement portfolio for here in third quarter 2025 at 10.46%. Hey, I'm pretty happy with that. It has been a pretty good year from a perspective of my retirement savings growth. I'll be honest, at the beginning of the year with the tariffs and all that stuff going on, I wasn't quite so sure, but hey, so far, so good. We'll have to see what happens in fourth quarter. I also have coming up in November enrollment in 2026 healthcare. I am on Obamacare. You're going to want to come back and see what are the impacts to the changes in Obamacare with my medical for 2026. I hope you'll come back for that as well. But either way, hey, thank you so much for watching. Thank you for being part of my channel and following along with my portfolio. I would absolutely love to hear from you. How was this year so far for you? What is your investment strategy? And then, hey, just what questions might you have? And hey, that's it. That is the third quarter results. I'm so looking forward to coming back and speaking to you in January, which is a much bigger deal. That will be the full year results and that net life review if you've watched that video in the past. But either way, thank you so much for being part of the channel. Thank you for your comments, your thumbs up, and all of that. I am so thankful for you being part of David in Progress. Thanks for watching.